An uncharacteristic fade in our bull market hero of NVIDIA. It has the market dragging its feet here into the close. Some red now after starting green. And another failed rally in the Russell 2000. Nate Peterson and Kevin Gordon are with me here this afternoon. An equity market dynamic duo. Nate's the director of derivatives analysis, and Kevin Gordon's the senior investment strategist at Charles Schwab. Great to have you guys both here this afternoon. Nate, let's start with a little short-term discussion here of the levels. I mean, look, whenever there's red, it's like a big event these days. But I mean, this is still part of that kind of steady grind we've been in.
Yeah, if you look at the S&P, yes. We just continually to remain above that 20 SMA. We continue to make new highs. If we get nuance, to your point, and we look at interpreting price action, there's a couple things that you want to look for to get a sense of whether we are fairly priced or whether there's still some more demand for risk assets. And you look at basically, number one, are we making new highs? Are the dip buyers coming in? That means, is the uptrend intact? Number two, where do we close on the day? Are we closing near the highs? Are we closing near the lows? This is only one day, but now we're down 4 days in a row, closing near the lows on the S&P 500. It's early because these are just very slight declines, but this is very nuanced behavior if you're a trader that you want to keep an eye on. Another thing to look for is, how do you respond on good news? Are you getting rewarded on good news, or are you selling off on good news? Because that can give you a sense or a hint that something is priced in. So uptrend still intact. We're getting nuanced. I feel like there may be some rebalancing that might be in play this week, which may create some more volatility. But otherwise, we're still technically intact here on the bull side.
Sure. I mean, the chart on the line looks like it's steady as it goes, business as usual. Maybe a little failed breakout for NVIDIA past its old high, but maybe it just takes a moment. You go back and test it, see how we feel. But the one thing that does seem to repeat itself, Kevin Gordon, is the fact that the small caps can't get it together. We keep trying, keep failing to get through 2100. One camp argues it doesn't matter when you've got big market cap concentration still in the megas and the indexes. But should that not tell us like something here on the margin if the Russell keeps failing? How many times can that happen?
Yeah, I mean, the tough part about that is, this is kind of the game of looking at an index versus looking at things at the member level or even the sector level. It wasn't, I think, 3 days ago that the industrial sector within the Russell 2000 made a new all-time high. And within the Russell itself, you're actually seeing the higher quality companies, so those with earnings growth and those with actual interest coverage ratios moving higher, those have actually been outperforming. So you can dig into that index, strip out all of the low quality parts of it and actually find some gems. But the weight of all the other names that are lower quality nature is such that it's going to drag down the overall index itself.
So it's just too heavy?
And then you have to kind of factor in.
It's just too heavy in those weak names? Because all these crypto tokens, they don't have any cash flows and they've been generating hundreds of billions. How come the Russell doesn't get any of that love?
Well, I mean, you have to consider also the difference in asset class, if you want to call both of them that. But I think for the Russell 2000 itself, the sort of linkage to rates in particular has been really interesting, because when you look at the correlation between changes in the Russell and changes in something like the 10-year, and compare that to the correlation between the S&P and the 10-year, you've had a much more of a softening this year with the latter. With the former, meaning the small cap fixed income relationship, it's actually been much more negative. So anytime you get this pickup in rates, it's put more downward pressure on small caps at the expense of large caps. So that's where you've got a lot of that underperformance. It's one of the reasons that large caps have been able to fare better. I think it's because of just sort of a better embrace or a stronger embrace of maybe a higher for longer environment where rates stay elevated and large caps can handle that better.
Totally. Love that point. As we've been talking about that, that's where I'm scratching my head, because I look at like the last, kind of gyrations in bonds. Yields have come down. The Russell's still not able to make that final push. And that's where I'm kind of trying to get any information on the margins about when our risk tolerance might be running dry. That's kind of why I think about this group, because it's supposed to be kind of in this higher risk camp. And I wonder if the Russell doesn't break out, then maybe we do connect that to, maybe watch Bitcoin to see if that breaks down. And then if that breaks down, yeah, go ahead.
The one thing to keep, I'll just jump in and add, something I should have added. The one thing to keep in mind is that when breakouts for the Russell and significant outperformance for small caps relative to large caps, that tends to happen after a recession over, after you've gone through a full Fed cycle. We haven't gone through either. I mean, we've gone through, what we've called rolling recessions, but that hasn't hit the broader economy from a labor perspective. So you haven't had that washout that typically sets you up well for the low quality trade in the parts of the market that are more levered to the economy. So because that hasn't happened, I think that's one of the reasons small caps haven't done well. But at the same time, doesn't mean that in an elevated interest rate environment, they can't do well. I mean, there were portions of the late 70s and all throughout the 80s where interest rates were still elevated, yet the Russell had, significant outperformance in some years relative to the S&P. So I think a big part of the story is just getting to less interest rate volatility, particularly for the Fed funds rate, which we, seem to be approaching now.
Isn't MOVE index like dropping like a rock right now? The bond volatility index? Yeah, because
I mean,
it's
elevated relative to history. I mean, it's still taken the place of being the one that's more volatile or more elevated, especially relative to the VIX. But, I think that's just because of the pressure for global bond yields moving higher has not just been a U.S. phenomenon, it's also been, a global phenomenon. So I think you have to keep that in mind. And in the fact that, number one, hasn't been a synchronous sort of picture from a global central bank perspective in terms of what the outlook is for rate cuts, because you still have key banks like the ECB and the Fed in pause mode, but the BOJ still hiking, I guess, because they just got back into positive territory. But also considering the fact that this is just a unique cycle, which we mentioned many times, but it's a unique cycle in market terms, it's a unique cycle in economic terms. I think that's going to be the primary driver of these splits, whether it's large versus small or manufacturing versus services.
Well, I like the point that sometimes it takes that recessionary event to then kind of normalize and then have the small caps outperform out of it. Maybe we just haven't ripped that Band-Aid off. Maybe we need to take a note from the Bank of Japan, Nate, and do one final push from the Fed to clear out the junk here. But it doesn't seem like we're going to get that from any of the commentary we've heard this week from the Fed.
Well, I think that's what's keeping a lid on the Russell there is that, it was encouraging to see that they kept 3 rate cuts, last week or whatever, but look how much that's changed over time, and look how many times that those probabilities have been wrong. And so until we get that, more certainty that the inflation data is coming down and cooperating much more to the Fed's toward the Fed's target, and that rate cut is coming, then they want to get in the Russell to be ahead of that first initial rate cut. We're just not there yet. We may not even get one this year. We don't even know yet. We're still data dependent.
All right. Nice. So I took us right into the bell, guys. Great stuff. Thank you very much. Knew it was going to be a fun one. Nate Peterson and Kevin Gordon. And